This is Ralph Sass, and this is the lecture for Accounting 211, Chapter 10, and once again, it'll probably be into approximately 15-minute units or sections. Chapter 10 deals with liabilities, and liabilities are debts that you owe to someone else. Okay. As a general rule, if the maturity is less than a year, it is a current liability. If it is longer than a year before it matures, it is a non-current liability. Sometimes you'll also see the in one operating cycle can also be another use in these particular cases. So current liabilities are less than a year, non-current liabilities are longer than a year. Keep in mind the whole idea behind this right-hand side, if you will, of the balance sheet on the debt and equity is how are we going to finance our assets? Okay, and you finance your assets either with debt, which is money that is borrowed, or you're going to finance it with equity, which is investments from business owners, what have you. Sometimes you need to estimate your liabilities. Okay, you need to do this when the liability is known to exist and the precise dollar amount can't be determined until a later date. In some cases, you need to do this. For example, suppose I have been sued and I was sued yesterday and I have no idea if I have any liability or not, what have you. In that case, I am just going to put that in my notes to the financial statements and say, hey, I've been sued and I have no idea what it's worth. However, and this was an interesting case when Exxon lost one of its pollution cases because the Exxon Valdez, they had nothing on their balance sheets until they lost the court case. Then after they'd lost the court case, they put a liability on their balance sheet to reflect the facts that there's a liability out there, it's known to exist, and at that point they could come up with an estimate of the dollar value. So if you can do items 1 and 2, you do need to put that on your balance sheet. So if there are warranty claims because of cars, warranties, what have you, then you do need to go ahead and put those on your balance sheet. A current liability, the usual items that are current liabilities are short term. Okay, usually they're obligations that are used to purchase supplies, what have you, that are going to be used in the business. Can include things such as utility and phone bills, office supplies. The one that's not on here is salaries for employees could be an accounts payable. Merchandise inventory receipts and invoices can be a payable. So anything that you're going to have to pay in the near future are going to be counted as accounts payable. Okay. When you're looking at notes payable are usually long-term liabilities. You're going to break them up, and you're going to break them up into a current portion and a long-term portion or a non-current portion. For example, I have a mortgage on my house. I have 25 years left. 1 year of that would be counted as a current note because 1 year is 1 year is less than the first, so 12 monthly payments, which is less than a year, are going to be the current notes payable, and the other 24 years are going to be the non-current notes payable. So I do need to take my notes payable and break them up into two portions. It's usually going to be done for things like loans, cars, mortgages, what have you. Okay. Boy, I, this is, I mean, so simple it's almost absurd. But a note payable will mention the amount. It'll be signed by the person that owes, or the company that owes the money. It'll also tell when it is due. Okay, in this case, it's 6 months after that November 21st date, and in this case, it'll also say an interest rate. This is overly simplistic, and they're a lot more complex than this, but we'll let that one slide. We also have accrued liabilities. These are items that are going to be paid in the future. This is where my liabilities may show up as well, in that I've recognized them. They're going to be made in the near future, but I may or may not have accounted for them yet. This is where those adjusting entries from earlier in the textbook are going to come into play. Things like interest payable, income tax payable, and accrued payroll liabilities. These are all short-term liabilities as well. So these are all going to be current liabilities, that I'm going to have to pay, and these are going to be the accrued liabilities. Keep in mind, payroll liabilities, when the company, take a look at your paycheck. The company has written you a check for, I don't know, $200 or $500 or whatever the amount is of your net pay. But then they've also held money for Social Security and Medicare. They've also held money for federal and state income taxes. You may have had money withheld for your pension plan. You may have had money withheld for medical bills, usually not worker comp, but there's usually a lot of items that were taken out of your paycheck. The employer holds those and remits those to the federal government, usually about once a month, okay, along with sales tax liability. If you're a retail company and you're collecting sales tax in the state of Virginia, you're required to basically submit that to the government every month. So you're going to have liabilities for a whole host of those things. So when they take money out of your check, they're going to show a liability on their balance sheet to reflect the fact that they owe the federal government or the state government that money on your behalf. Another form of liability is unearned revenue. Once again, this is going back to the chapter on adjusting entries. Okay, when cash is collected before the revenue is actually earned, things like those football tickets at Virginia Tech games. So there will be a liability account for that unearned revenue, and that's going to also be a short-term liability. Then we can also have long-term liabilities, and long-term liabilities are going to be over a year, and that's going to be money that's borrowed. And the thing I want to point out here is most of us know that we can go to banks to borrow money, but there are two that we often forget about, and those are insurance companies and pension plans. Insurance companies can be a great source to borrow money from. They have a lot of money, they want to invest it, and they do make loans. And the big ones, I mean, y'all know and drive by are like State Farm, what have you, but they do make loans. And then finally, pension plans, especially for mortgages and things like that, they have a liability that they're going to owe 30, 40, 50 years out of a pension, and they're looking for a long-term asset, and very often they will also lend money. So I like to point out that, we all know banks, but insurance companies and pensions can also be great places to borrow money for long-term liabilities. Sometimes you need to buy bonds or issue bonds, I should say, to meet the needs. And when you issue a bond, you're selling that particular liability to a number of different people to get the amount of money that you need. For small businesses, it's not required, but for big businesses, it is. Okay. If you have a bond or a note that is gonna be refinanced, okay, if management, and notice what it says at the bottom, has both the intent and the ability to refinance soon to mature obligations on a long-term basis, these obligations are classified as long-term liabilities. Suppose I have a mortgage, and the mortgage is, I have a balloon payment due this year or a big payment due this year of $1 million. Everybody knows I don't have $1 million, but I have the ability and the intent to refinance it over the next 30 years. Even though it's due in the next year, is it okay to count that as a long-term liability? Yes. Why? Because I have the intent and the ability to go ahead and turn that short-term obligation into a long-term obligation, so it can be classified as a long-term liability. A lot of times we have installment notes payable. Y'all run into this when you've made purchased a car on a loan, what have you. And what an installment note calls for is a series of, generally speaking, equal installment payments. And notice each payment is going to cover both the interest and a portion of the principal. When you make your car payment every month, part of that payment goes to interest and part goes to reduce your principal. Okay, and what happens is that with each payment, the interest portion gets smaller and the principal portion gets bigger. So as each payment's going on, the payment is staying the same, but the amount going to interest and the amount going to principal changes. And you do need to figure out and calculate what we're going to see here in a minute, because we do need to allocate the payment between principal and interest. So what we have to do is we have to create what we call an amortization table. Okay, and usually if you talk to your bank or you talk to your financing company, they will provide this for you. And what you have to do is find out for every month what your interest expense is. And to figure out your interest expense, you have to take the unpaid principal, how much you haven't paid, multiply it times the interest rate. And they don't have it here, but you really also need to multiply it by time. And that time is usually a month. And then when you submit the payment every month, what happens is your balance goes down. So let's take a look at some numbers here to see how this works. On October 15th, year one, they purchased furnishings cost of $16,398. The loan was an 18-month loan, had interest at 12%. Monthly payments are $1,000 beginning on November 15th. So notice the amortization table. Let's start off row one all the way over at the far right, column D. Their balance is $16,398. Okay. Then notice on November 15th, they make a mortgage payment of $1,000. And then notice the interest is $164. Oh. How did they calculate that $164? They took 1% of the unpaid balance. So they took one, and 1% is 12% per year. That's how they got that. So they took $16,398, multiply it times 1%, and it's $163.98. They rounded it to $164. So of that first payment of $1,000, $164 goes to interest, $836 goes to reduce the balance that's due. So notice what happens. You go from $16,398 minus $836 gives you $15,562. Then you make the next payment. Notice you pay $1,000. $156 is going to interest. How'd they calculate $156? They took $15,562 times 1%. It's $155.62. They rounded it to $156. $844 is going to go to the unpaid interest or the reduction in the balance, and the balance falls to $14,718. They're going to keep doing this all the way through, and then at the end of they've made 18 payments, they will have paid off this particular loan. Now let's go ahead and take a look at what this journal entry looks like. The journal entry looks like this. We have a debit for interest expense of $164. Where did that come from? That came from column B, $164. I have an installment note payable of $836. Where did that come from? Column C. And notice my cash went down by $1,000. This illustrates an important point. I wrote a check for $1,000. Only $164 counted as expense. The other $836 went to reducing my installment notes payable. So just because I wrote a check, this goes all the way back to chapter 1, doesn't mean it's an expense. In this case, I wrote a check for $1,000 and the expense was only $164. Okay. On December 31st, keep in mind that they're making these payments on the 15th of the month. So we do have a journal entry that we need to make for an adjusting entry. And in this case, it's for $74 to record the half months of interest. So they take the $14,718 times 1% times a half to do it for a half a month. And that is their adjusting entry, interest expense, interest payable. And it looks exactly like the adjusting entries we did back in chapter 4. That concludes where I am going to stop for this video, and we will pick it up with bonds payable on the video to the second part of chapter 10.